Welcome back to our channel, where we delve deep into the intricate world of economics. Today, we're dissecting a topic that's been making headlines worldwide: China's deflation. Stay tuned as we uncover the underlying factors and implications of this economic phenomenon. China's economic journey has been nothing short of remarkable in recent decades, boasting an impressive average GDP growth of nearly 10% annually. However, the aftermath of the pandemic has posed unexpected challenges to its economic resurgence. Factors such as dwindling consumer confidence, a sluggish housing market, and surging local government debt totaling a staggering 92 trillion yuan, equivalent to $12.8 trillion, have hindered the anticipated rebound. In a surprising turn of events, the world's second-largest economy has veered into deflation territory for the first time in 2 years. Consumer prices took a dip, falling by 0.3% year-over-year in July 2023, before showing a marginal uptick of 0.1% in August. China's predicament stands out amidst the global landscape of post-pandemic recoveries. Rather than grappling with inflationary pressures like many of its counterparts, China finds itself grappling with intensified deflation risks. This distinction marks a significant milestone, making China the inaugural G20 economy to register a year-on-year decline in consumer prices since August 2021. Curious minds might wonder, what led to China's recent plunge into deflation? Well, the deflationary trend in China can be attributed partly to the downturn in the global commodity cycle, which includes the easing of supply chain pressures. However, the more significant driving forces are unique to the domestic landscape. For starters, governmental policies have prioritized bolstering production and investment over stimulating consumption, resulting in subdued domestic demand. Additionally, households are holding onto their savings more cautiously amidst a progressively uncertain economic climate. We also highlight the issue of high unemployment in China, particularly among the youth, which contrasts with the wage inflation observed in other nations. Zooming in on specific sectors, China's real estate downturn looms large over its economy, exerting renewed pressure on home prices. This weakness in the housing market reflects the softening of rental costs in CPI components. Furthermore, factors like auto price reductions and the decline in port prices due to oversupply are compounding the deflationary risks. China plays a pivotal role in shaping global goods disinflation, according to Nora Centovani, senior economist at J.P. Morgan. She explains that during 2021 and 2022, while much of the world was recovering from the pandemic, China experienced lockdowns. This period coincided with a significant surge in global goods demand alongside negative supply shocks and widespread disruptions to domestic supply chains. As China reopened in early 2023, the rest of the world was slowing down, leading to a scenario where the boost to global demand from China's reopening was overshadowed by the boost to global supply. This surplus supply dynamic has pushed China's domestic and export prices into deflation. Export prices from China have been plummeting at a rate of 18% annually in the 3 months leading up to July, driven by exporters slashing prices to stimulate demand. Initially led by processed raw materials, the price declines have now extended to other crucial exports. This reduction in upstream prices has subsequently lowered costs for downstream producers in China, resulting in substantial declines not only in processed materials like metals and chemicals, but also in lower-end consumer goods. This trend is amplifying the near-term impact on major trading partners, such as the United States and the Euro area, where import prices from China have seen significant decreases. Furthermore, the depreciation of the yuan over the past year has exacerbated China's disinflationary effect on global import prices. Since about 2/3 of China's goods trade is conducted in dollars, and the rest in CNY, the strengthening of most major currencies against the CNY is driving down import prices in local currency terms, particularly in regions like Latin America and Europe. In summary, Centovani suggests that China's export price deflation, coupled with the decline in its trade-weighted currency, is likely reinforcing the ongoing slide in global core goods inflation. When combined with other short-term disinflationary pressures, such as diminishing supply bottlenecks, China's surplus supply is expected to undermine the pricing power and profit margins of goods producers worldwide. People might also wonder, what factors are contributing to the downturn in China's housing market? Since 2021, China's housing market has been undergoing a downturn, both cyclically and structurally. This trend began when several property developers defaulted due to stricter regulations on their debt limits. Consequently, new home sales have plummeted to just 50.9% of December 2020 levels, while house prices have experienced a relatively mild decline. According to Tingting Ji, China economist at JP Morgan, apart from macroeconomic and financial pressures, a double-dip scenario in the housing market, characterized by two periods of contraction separated by brief expansions, could erode market confidence in the Chinese government's ability to manage risks and stabilize growth. To address these concerns, the government implemented several demand-side easing measures towards the end of August, including reducing down payment requirements. However, uncertainties persist regarding the potential impact of the seasonal pickup expected in September and October on the market in the coming weeks. Be sure to give this video a like if you are enjoying the content. So, is deflation a long-term problem in China? Deflation, a situation where prices generally decrease, is causing concerns in China's economy. Experts predict that this issue will stick around for the rest of the year. Although there might be a short increase in the Consumer Price Index, CPI, toward the end of the year, overall inflation is expected to stay low. The reasons for this expectation have a lot to do with the way China is managing its economy. Recently, the government has tried to give it a boost by introducing some plans to help with big-picture economic issues and housing. For example, they reduced the amount of money people need to put down when buying their first or second home. However, the effects of these changes might take some time to show up in the economy. Many experts agree that China's overall pricing situation will continue to be weak in the coming months. One big reason for this is the difference between how much stuff is available and how much people want to buy. It's like when you have too many apples in the basket, but not enough people want to buy them. It takes time for this situation to change. Experts believe that more needs to be done to solve this problem. They say the government should do things to help people make more money, so they don't feel like they have to save every penny just in case something bad happens. They also think the government should help businesses that make things people want to buy. In short, whether deflation becomes a long-term problem in China depends on a lot of things, like how the government handles the economy and whether people feel confident enough to spend their money. Deflation, characterized by a sustained decline in the prices of goods and services across an economy, has become apparent in various aspects of China's economic landscape. In July 2023, China's Consumer Price Index dropped by 0.3% compared to the previous year, marking the first such decline since February 2021. Additionally, the Producer Price Index has experienced a continuous decline for 10 consecutive months, with a year-on-year decrease of 4.4% in July 2023. The impact of deflation extends beyond just these headline indicators. Microeconomic indicators such as industrial value-added output and profits of large industrial enterprises have shown a significant divergence since 2019. Industrial profits witnessed a noticeable drop of 3.3% in 2019, and this trend has intensified in subsequent years, with year-on-year declines exceeding 20% every month in 2023. This persistent decline in industrial profits underscores a broader decrease in the prices of industrial goods since 2019. Notably, deflation has hit the industrial sector particularly hard, resulting in numerous closures among private enterprises located in key manufacturing regions, like the Yangtze River Delta and the Pearl River Delta. This downturn in the industrial sector poses a significant challenge to China's status as the world's factory, with potential repercussions for global supply chains and trade dynamics. Several underlying factors contribute to China's deflationary trend. For instance, in 2022, China experienced a notable decrease in labor productivity, declining by 4.8%. Furthermore, China's monetary supply has expanded significantly, reaching 2.5 times its gross domestic product, GDP, while the medium-term lending facility rate continues to decrease. These economic indicators point towards insufficient aggregate demand as a primary driver of deflation. Consumption, investment, and net exports have all fallen short of expectations, exacerbating the deflationary pressures. The consequences of deflation, particularly when driven by insufficient aggregate demand, are grave. Such a scenario can set off a harmful cycle wherein reduced consumption stifles economic growth. In response, businesses may scale back production and investment due to uncertainty about future demand, leading to higher unemployment rates. This, in turn, further depresses overall consumption, creating a self-reinforcing loop of economic decline. Addressing deflationary pressures presents a formidable challenge for China. Monetary policies implemented by the People's Bank of China may prove ineffective in such an environment, complicating efforts to stimulate economic activity. Thus, finding sustainable solutions to boost aggregate demand and counteract deflationary forces becomes imperative for China's economic stability and growth prospects. Thanks for watching. If you found this video informative, don't forget to leave a comment below with your thoughts on China's deflationary challenges. Remember to give this video a like, share it with your friends, and subscribe to our channel for more insightful content on economic trends and global affairs. Stay tuned for our next video. And until then, keep learning and stay informed. See you next time.